Welcome to Build Your Legacy, the CRE Playbook podcast, where we break down real deals, real strategies, real opportunities, along with education in commercial real estate. We are your hosts, Alex and Sarah, with Bata Commercial Group and KW Commercial, and this show is designed for investors, developers, business owners, and agents who want to build long-term wealth through commercial real estate. Let's get into today's play.
Yeah, let's jump right in.
So you've seen the headlines, right? The Federal Reserve holds rates. The media is, screaming about this impending commercial real estate apocalypse.
Oh yeah, the sky is definitely falling if you believe the news.
Right. And so the natural instinct for you, for most people, is to just pull back, hoard your cash, wait it out.
Yeah.
But you're probably wondering, the higher interest rates automatically make commercial real estate a bad investment?
It's the big question right now. And, well, most people say yes. They look at a high-rate environment and they just see dead deals everywhere.
Yeah, the casual observers.
Exactly, the casual observers. But here is the twist, and it's a big one.
Yeah.
If you look at the wealthiest, most sophisticated investors,
Just down here in Florida, right?
especially in Florida, they don't just, tolerate high-rate environments. They actually prefer them. They actively hunt in these conditions.
Which sounds completely backwards to most people. But we aren't just, theorizing about this today. Today's deep dive is built on this amazing strategy playbook that was put together by Jack Bataoel.
Yeah, the director and lead agent for our team.
Right, at Bata Commercial Group at KW Commercial. So Jack compiled these highly specific notes and models to help our Florida-based clients and you, the listener, really understand how institutional-grade investors are evaluating opportunities right now.
Regardless of what the Fed is doing.
Exactly. So to really understand why Jack's strategy works, we have to start with the mechanics. Like, how are these deals actually funded?
Yeah, because we literally cannot talk about high interest rates without talking about leverage. It is the absolute center of gravity in commercial real estate.
Right, because people aren't usually paying all cash.
No, I mean, maybe a rare few, but institutional buyers aren't writing all cash checks for like a $50 million retail center in Orlando. They're using debt. They're borrowing 60, 70, sometimes even 75% of that money.
So I like to think of leverage sort of like, imagine you're trying to buy a fleet of charter boats down in a Miami marina, right?
Okay, like that.
If the cost of the boat fuel, which is the borrowed money in this case, if that fuel stays super cheap, you can run a ton of boats. You can afford a huge fleet.
Your returns explode because the cheap fuel is doing all the heavy lifting.
Exactly. But if the price of fuel skyrockets, suddenly the size of the fleet you can afford just shrinks drastically.
That's actually a perfect analogy. Because the commercial real estate asset class is so incredibly reliant on that leverage, the cost of the debt acts as this ruthless filter on the market.
It changes everything.
It does. And Jack maps out exactly what rising rates directly impact. It basically hits three main pressure points.
Okay, what's the first one?
The first one is the most obvious. Financing costs. Higher rates just mean higher loan payments. Period. Your monthly mortgage on a new loan is going to be significantly higher than it was 2 years ago.
Right. And then that leads directly to the second pressure point, which is purchasing power.
Yep. An investor with, say, $2 million in liquid cash, they simply qualify for a much smaller property today. The bank won't lend them as much because the payments are higher.
Which brings us to the third one. And this is where, the market really breaks. Property values.
Exactly. If buyers can't borrow as much, they can't pay as much. The physical bricks and mortar cannot command that same premium price. The purchase price has to drop.
And since purchasing power is getting squeezed so hard by these rates, what happens to the actual day-to-day operations of the property?
Well, that all comes down to the lifeblood of commercial investing, which is cash flow.
Right. Jack's central thesis in his notes.
Quote, cash flow is the key to most investors' success, unquote. That is the golden rule.
Oh, wait, let me push back on that a second on behalf of the listener. Because, people buy residential houses in high-rate markets all the time.
Sure, they do it every day.
Right, because they fall in love with the neighborhood or, they really need that specific Boca Raton school district for their kids. Why is commercial so different?
Because residential real estate is driven by emotion. It's utility, it's lifestyle. It's the feeling you get when you walk in the door.
You want the nice backyard.
Exactly. A family will stretch their budget to the absolute breaking point to afford an 8% mortgage just to get their kids into that school. Commercial real estate is completely devoid of that emotion.
No one's buying a strip mall in Tampa because it has good vibes.
Right. You buy it strictly for the income stream, the ROI. If the debt service gets so expensive that it cannibalizes your income, the spreadsheet just says no.
The deal dies.
The deal dies. There's no emotional premium that's going to step in and save it. So if debt costs rise, cash flow shrinks. And when cash flow shrinks across the market, property values physically have to adjust downward.
So how do we actually measure that adjustment? Because, Jack's notes spend a lot of time on this. We use a metric that, frankly, confuses a lot of newcomers.
Oh, absolutely. But it's second nature to our team at Bata.
Right, the cap rate. Capitalization rate. Let's just give a super quick refresher for the listener. The basic formula is your net operating income, your NOI divided by the purchase price.
Right.
So using the specific example Jack gave in his notes, if you have an NOI of $100,000 and the purchase price is $2 million, that equals a 5% cap rate.
Perfect. Simple division.
But here's where it gets really interesting and honestly super counterintuitive if you're coming from the residential side.
Yeah, this trips people up constantly.
Jack's notes specifically say that buyers actually want higher cap rates and sellers want lower ones. Can you kind of unpack why a buyer wants a higher number? Usually we think higher price means better.
Right. But in commercial, you have to think about the inverse relationship. A lower cap rate means a higher property value. That is fantastic if you are the seller. You're cashing out at top dollar.
But terrible for the buyer.
Exactly. A higher cap rate means a lower property value, which is great for the buyer. But it's really about the spread between the interest rate and that cap rate.
Okay, walk me through that.
So a cap rate is basically your return on investment if you bought the building in all cash, right? No loan.
Right, your unlevered yield.
Yep. So if your cost of capital, your interest rate from the bank is, say, 7%, you absolutely cannot buy a property that only yields a 5% cap rate.
Because you'd be losing money from day one.
Exactly. You're paying the bank 7%, but the buildings only give you 5%. That's negative leverage. You're bleeding cash. So when interest rates rise, investors demand more return to compensate.
They need a healthy spread.
Right. If debt is at 7%, a buyer might demand an 8 or 9% cap rate just to make sure the property actually cash flows. But the property's income, the rent from the tenants, that doesn't just magically double overnight.
The leases are what they are.
Exactly. So if the income is fixed and the buyer needs the cap rate to go from 5% to 9%, there is mathematically only one way that happens.
The purchase price drops.
The purchase price plummets. The seller has to take the hit.
Wow. Okay, let's move from the theory to reality because Jack Bataoel provided this incredible real-world case study in his playbook, a multifamily investment right here in Florida.
Yeah, this example really shows how violently a rate hike alters a deal.
So imagine a mid-sized apartment complex. Scenario 1. Before the rate hikes, this property was priced at $2,650,000.
Right. And back then, a buyer could get a 4% interest rate.
Which feels like ancient history now.
Seriously. But at that $2.65 million price tag, with a 4% loan, the building performed beautifully. After all the expenses and the mortgage were paid, it generated a positive cash flow of about $32,000 a year for the investor.
Which is a solid deal. You buy the building, the tenants pay down your loan, and you put $32,000 in your pocket every year.
It's a great setup.
But then here comes the shock to the system. Scenario 2, it's the exact same property, same roof, same tenants, same exact rental income.
But the interest rate jumps to 7.85%.
And suddenly the math just breaks.
It totally breaks.
Yeah.
Because the cost of the borrowed money nearly doubled. That $32,000 of positive cash flow doesn't just shrink, it evaporates.
It goes negative.
Yeah, the property's income didn't change at all. Only the financing did. But now the investor would have to write a check out of their own pocket every month just to keep the lights on.
And as we just established, commercial buyers don't do emotion. No one is touching that deal at $2.65 million.
Not a chance.
So to get a buyer, the market has to correct. The property has to offer that original $32,000 yield, even with the new 7.85% interest rate.
Right. The math dictates the outcome. Jack ran the underwriting on this exact scenario. To restore that cash flow, the purchase price must decrease to approximately $2,020,000.
That is insane. That is a massive aha moment right there. I mean, think about it. That is a value change of roughly $630,000.
Wiped out.
Just wiped out. Over $500,000 gone purely from an interest rate shift. The building didn't burn down. The tenants didn't leave. The Fed just moved a number.
Which is exactly why you need an expert team like ours to run these numbers for you, because the market is unforgiving.
It really is. But wait, if values are dropping by hundreds of thousands of dollars, why on earth do professional investors jump in while the amateurs are running away?
Because professionals understand the difference between market timing and deal timing. Amateurs try to time the market. They sit on the sidelines and say, oh, I'll wait for rates to go back to 3%.
Which might never happen.
Exactly. And if rates do drop, what happens? All the amateurs rush back in, cap rates compress, and you're instantly in a bidding war again. The price of that property shoots right back up.
So the smart money buys now. What are the actual advantages of buying in this high-rate environment? Jack's notes listed a few.
Huge advantages. Number one, less competition. All those casual buyers and syndicators who relied on cheap debt to make bad deals work, they're gone.
So you aren't fighting 20 other offers?
Nope. Number two, more negotiation power. Sellers who have to sell right now, maybe their loan is maturing and they can't refinance, they become highly, highly flexible.
Because they have a ticking clock.
Exactly. Which leads to number three, better terms. You're not just negotiating the price. You can get longer due diligence periods. You can negotiate rate buy-downs.
Oh, and seller financing.
It's huge. Seller financing is making a massive comeback. If the seller needs to exit, they might act as the bank and give you a loan at, say, 5%, just to get the deal done cleanly.
It's kind of like, think about looking for a prime beachfront commercial spot during a really gloomy Florida downpour.
I love this.
Right. Everyone else stayed home because the weather is terrible. So you just stroll in, you have the absolute pick of the best properties, and you have all the leverage to negotiate a crazy deal.
That's exactly what it is. And then there's the final key piece of the strategy, future refinancing.
Okay, tell me about that.
Smart investors buy the property at that severely suppressed price today, that $2 million, $20,000 basis we talked about.
Yeah.
They secure the asset, and then they just wait. When financing costs eventually decline in the future and property values recover, they simply refinance.
But they've locked in that low purchase price forever.
Exactly. Your basis is permanent, the interest rate is temporary.
Wow. Okay, so knowing that high rates are actually this incredible opportunity, what specific metrics should you, the listener, be looking at? Because you can't just obsess over whatever the Federal Reserve chairman said on TV yesterday.
No, you have to look at the actual asset. And Jack Bataoel laid out this exact checklist for what modern investors need to watch.
Let's go through it. First up, NOI growth.
Right. Can the rents actually increase? You can't rely on the market to naturally boost your property value anymore. You have to force the appreciation yourself by driving up the income.
Are these rents below the Florida market average? Can we add value?
Exactly. The second thing on the checklist is occupancy.
Meaning, is the demand strong? Like, if a tenant leaves, how fast can we replace them?
Right. Sticky locations. Third is lease structure. And this is huge in Florida right now. Are the leases triple net, which we call NNN? Are they modified gross or full service?
Well, let's expand on that real quick because inflation and insurance costs are insane right now.
Oh, they're crushing people.
If you have a gross lease, the landlord is paying the property taxes and the insurance, right?
Yep. So if your Florida property insurance jumps 40% this year, the landlord eats that entire cost. Your cash flow is dead.
But with a triple net lease.
With a triple net lease, the tenant absorbs those rising costs. They pay the taxes, insurance, and maintenance. It is a literal shield for your NOI against inflation.
That is so crucial. Okay, fourth on Jack's checklist, debt structure.
Yeah. If you are assuming a loan, is it a fixed rate? Is it floating? Is it interest only? You have to underwrite the debt just as ruthlessly as the physical building.
Buying a great building with toxic debt is a disaster.
A fast track to losing all your money.
And finally, the fifth point, the exit strategy.
Can the asset be refinanced later? Can you add enough value to sell it to an institutional buyer in 5 years? You have to know your way out before you ever wire your deposit.
Which makes perfect sense. All right, let's transition a bit and rapid fire bust 3 common myths that Jack highlighted from the source material, because there's a lot of bad info out there.
Oh, there's so much noise. Let's do it.
Myth number 1, no one buys when rates are high.
Completely false. Transactions are happening every single day. The highly capitalized private investors and family offices are actively stepping in right now to buy distressed assets.
Yep. Myth number 2, high rates automatically mean bad investments.
False again. We just proved that with the case study. A great asset purchased at a severely discounted basis, even with an expensive loan, is a much better investment than overpaying for a mediocre building just because the debt was cheap.
The price you pay matters more than the rate. And myth number 3, I should wait for rates to fall.
Absolutely false. No one, not even the Fed, can perfectly predict rate movements. Professional investors don't wait on headlines. They buy based on the numbers right in front of them today.
Man, that is so clarifying. So to kind of summarize this whole deep dive, interest rates absolutely matter. We aren't saying they don't,
Right, they change the math significantly.
but they are just one variable. The goal is never to buy just because rates are low. The goal is to buy when the numbers make sense. And honestly, that distinction alone has made many commercial real estate investors millions of dollars.
It's the whole game. And I want to leave the listener with a final kind of provocative thought here.
Let's hear it.
We know that high interest rates temporarily suppress property values, right?
Right.
Well, imagine what happens to the equity of an investor who buys strategically today at that lower basis, aggressively forces appreciation through renovations and operational efficiency.
Driving up that NOI.
Exactly. And then they also benefit from a future rate drop. The cap rates compress again, multiplying the value of that newly increased NOI. The wealth generated in that scenario isn't just incremental. It is completely exponential.
Wow, it's like a slingshot effect.
Precisely. You pull the band back during the high-rate environment, and you let it fly when the market shifts.
That is powerful. Look, to get an even more in-depth deep dive on how you can be successful in commercial investing, or to find the right place for your Florida business to thrive, you need to visit our website at www.batacommercial.com.
That is spelled B-A-T-A.
Yes, B-A-T-A. Reach out to an agent from our group today. We are here to help you navigate this exact market.
We've got the data, we've got the playbook.
If you found value in today's episode, make sure to subscribe and share it with someone who's serious about growing in commercial real estate. If you're looking to buy, sell, lease, or invest, or if you're a developer searching for your next opportunity, reach out directly. And if you're an agent ready to build your commercial business, let's connect. Until next time, go build your legacy.